The month of August, when almost all the companies report their profit for the full or the half year. Well, it's always a litmus test of markets, of the economy and of the future. On the surface, the 6 months to June was, well, pretty sound. Most companies reported higher earnings and revenues, but the share price reaction, I've got to tell you, was varied, with some big share price falls more common than big share price increases. But the outlook does suggest broking analysts are now downgrading their outlook for the next 6 months, which could be a bit of a drag on share prices going forward. Junbei Liu is the manager of the Tribeca Alpha Plus Fund and joins me now. Junbei, always good to chat to you at these times. What was your own sense of the themes coming out of this reporting season?
Hi, good afternoon, Ross. Thank you so much. Out of this reporting season, we certainly feel it has demonstrated how resilient our economy has been. So in terms of the revenue, corporates reported pretty good revenue, but the cost was higher as expected. And what's the big surprise out of this reporting season is really the guidance, the company's guidance for 2024. Clearly, the top line is slowing. Costs will continue to escalate higher, but the big surprise was the interest expense. We know the interest rate has been put up for many months now around the world and here in Australia. But in terms of the consensus miss, so the analysts' misestimate of the interest expense was so significant that we are seeing quite a significant downgrade to 2024. In fact, on aggregate, ASX 200 total earning has been downgraded by a very large 2%, and that compares to normally 0.7%. So very large very large downgrade for the next 12 months, and mainly on the interest and slight weakness on the economy.
So as you're now scouting out through these profit reports, are you seeing any opportunity, any buying opportunities out there? Or is it one of those things where the opportunities are now becoming significantly limited? Are there any themes that gave you the sense of opportunity in terms of buying shares?
Look, absolutely. This reporting season was, as you said, was quite volatile. And we see a lot of big share price movements on day one. And then the next day, you kind of seeing the reversal of those reactions. It's really thanks to a really lack of liquidity and also, lack of understanding of some of those businesses and the different moving parts. So for us, we saw a lot of opportunities. Number one, the big thing coming out of this reporting season was AI. There's businesses, of course, likes of NextDC, the likes of Megaport. It have good exposure to that sort of explosive requirement of data center and usage of data. We've seen the share price move quite significantly in the case of in the Megaport, where the company is actually now can cut some costs and continue to grow quite significantly. We also see another company, which is a bit of an unlikely candidate for the sort of AI exposure, is Goodman Group. We know Goodman Group as this, amazing industrial business leader. They have great relationship with likes of Amazon rolling out the logistics centers. But what they have said in this reporting season is how much of their future pipeline has now been converted to working with the large data center operators. And they talking about in the next few years, there's incredible demand for this company. And then with the pipeline they have at the moment, it's up to something like $40 billion. It's already being negotiated and talked about. So a lot of opportunity for that company now is in process to transition into AI. So a lot of opportunity. There's another area I should touch on is the novated lease space that investors has really sort of missed a step in that front. There was a lot of optimism heading into the result, thinking that because of the legislation change in late last year, these companies would have been big beneficiaries of the electrical vehicle pickup through the novated lease. It was, however, not as much as expected by the analysts. So share price have fallen, but they do provide good buying opportunity because those companies in the next 12 months will have significant earnings upgrades.
Yeah, there were companies like AP Eagers that had a big bounce earlier. There was also Macmillan Shakespeare's, another one that does that. Well, let's take you to some of these companies that have done especially well during this period. You mentioned Goodman Group there was one. Cochlear was another that really stood out amongst the top 50 companies, what their share price has done over the course of this month. James Hardie put in a cracking result, which was off the back of its US operations. A couple of surprising big companies. You got Brambles with Chet Pallets, did better than than expected. Wesfarmers also is another one, which is a retail space, which you'd expect to maybe dragging the chain a little. It did exceptionally during the course of this month.
Look, it's been incredible. You're absolutely right. In this reporting season, it certainly seems like most of in the case of most of the large quality leaders, big companies, they have done very well. And then their results were beating the expectations, and also their guidance for next year are very much better than what people are expecting. Their underlying business momentum is strong. Their pricing power is strong, and so has driven quite a significant earnings upgrade. And this really comes down to, with quality company, they have strong franchise and they have pricing power. When the economy slows down, these companies will be the one to hold up and deliver returns.
And very quickly on the other side of that, we look at the companies that didn't do so well, their share price. So we're looking at companies that had really cost blowouts and they weren't able to get it back. So this included, say, Coles, Ramsay Health Care, South 32 was another, then Qantas for other reasons there, and Lend-Lease, which has got the commercial office issue that's going to be ongoing. So there's the opposite to what we just explained.
Look, absolutely. In the case of Coles, it was actually quite rather disappointing for investors because Coles has been expected to deliver pretty stable return because we know consumers still spending in the supermarket and the pricing environment has been very strong. Both supermarkets have put up their prices in the high single digit in the last 12 months. So what has been disappointing? It really comes down to perhaps new management is rebasing some of the earning expectation. They talked to some of the stock shrinkage, theft, and a few other things, small things that cause a bit of a consensus downgrade. So it has been punished very aggressively. On the other hand, Woolworth has actually demonstrated a pretty good result despite some of those similar issues affecting them.
Jimbo Liu, always good to get your input on this profit reporting season. Many thanks for your time.